Okay, my name is John Clark, Worldwide Category Marketing Manager for Integrated Workplace Management Systems at IBM. Today I'm going to be talking to you about some pending changes from the financial accounting standards boards of the world that really do impact your organization. We're going to be talking about the use of IBM TRIRIGA to comply with these new lease accounting standards. So why don't we get started? First of all, we have to understand that the accounting standards boards for Europe, that is the International Accounting Standards Board, and the US-based Financial Accounting Standards Board are really working together to define a global set of accounting standards. What this impacts, of course, is things like revenue. What is revenue? When do you recognize it? One of the big impacts of this is really the move of leases from an operating expense to an asset on the balance sheet. And while no global analysis has been undertaken, certainly within the US, the Goldman Sachs has estimated that the impact on the S&P 500 is about $1 billion per company. A recent IBM survey found that across organizations, across about 180 senior finance and real estate executives, 92% consider themselves not well prepared. So let's get into some of the details of this. This has a major effect on certain areas. As you can see here, the S&P 500 generally across the S&P 500 is about a 3.2%. But certain industries, in particular retail, telecommunications, financial services, have a much greater impact. For retailers, it's about 18.5% on average. So a significant impact to them. So what have we found? Well, certainly one of the things that we've found is that compliance is going to take a significant amount of effort to implement. Our survey found that somewhere between 6 and 24 months, in fact, to implement. And for most organizations, the number of leases that they're dealing with is certainly measured in the thousands. These are comprised of real estate leases for their locations, as well as for asset, vehicle, other types of fleet infrastructure type leases. So a significant number, and the scope of effort required here is significant on the part of organizations. To comply with these changes, we found in discussions with these senior finance and real estate executives that 62% of them on average are looking for new systems to meet two aspects of it: compliance, number one, and really to simplify the complexity on the other side. Some of the details behind this, about 60% of organizations are focused in on changes, upgrades, new systems for their enterprise asset management, and just under that amount, 56%, are looking for new real estate management systems to comply with these new rules. We sat down with a number of our customers, with the survey respondents, with a customer advisory board comprised of 31 significant organizations, world-leading organizations, to understand really what it was that's required here. Number one, they identify the need for systems to bring in the data in an accelerated fashion, to get a handle on their inventory, to analyze the impact going forward. Many of them are using Microsoft Excel or other homegrown systems often to comply with these changes today, or to comply with their lease accounting requirements today. And they've realized that these systems are largely going to be ineffective in the future. They don't meet stringent audit requirements. They don't meet the demands in terms of managing these number of leases. So for many, you're talking about, say, several thousand leases. Those leases will then have decisions made around those as to whether they'll extend them, terminate them early. All of these decision points have to be audited. And decisions, the approvals and the audit processes significantly increase the amount of data required here. And then beyond compliance, what we've heard is this really is providing a catalyst for organizations to look at their assets, their leased assets in particular, and look at the effectiveness of those assets in supporting their business enterprises. For many, they're finding that they have underutilized assets. They have vacant space, they have underutilized space, and they're looking to take this as an opportunity to consolidate those locations and drive increased asset efficiency. So what do they require in a system to manage this? Well, number one, they're looking for a single system to cover all types of leases. Those are the real estate or real property assets, it's the equipment, and other infrastructure required. And they're looking at it both from an operational as well as a financial management perspective. So the operational processes around lease tracking, the compliance with the new changes, as well as the reporting associated with that. They're also looking really to avoid financial restatements. At any time new rules come into effect, organizations have to look at their information, look at the reports that are generated from these different processes, and make sure that they're in alignment with the rules. Of course, if they're not, auditors may find these and require them to restate their earnings. And then lastly, as I said earlier, organizations are looking for systems to really rationalize their portfolio, optimize it, and shed the real estate assets, in particular because they have the largest balance sheet impact, before these rules bring them onto the balance sheet and they take a detrimental effect on their return on assets and debt to equity ratios. So a couple of key points there. So what is it that IBM TRIRIGA delivers? Well, first and foremost, it delivers a set of capabilities that accelerate the capture of the real estate and equipment leases from third parties. Because in many organizations, we've found that the work required to load all of the lease data is going to be undertaken by third parties rather than internal resources that are already have full-time jobs. Second, they're looking to gain some sort of an assessment as to the balance sheet impact associated with renewals and new transactions as they enter into them today, because the new rules don't allow for grandfathering. Number three, certainly they're looking to simplify the complexity. There's a lot of information that's required here, really from an operational perspective. For instance, market conditions in a particular suburb, let's say, may be changing over time. Lease rates may be escalating or declining. And these represent operational impacts and assumptions that the organization is going to have to evaluate on a periodic basis to determine if they're going to renew or terminate early. Those decisions, as I said earlier, need to be tracked and ultimately reported. It also generates the audit reports. So as those decisions are made, as the balance sheet impact modifies based on those assumptions, all of this data is tracked and can be provided from an audit perspective. And then lastly, the facility planning scenario analysis to really reduce those facility assets. Now this is applicable in three stages as the new rules come into effect. First of all, they're expected to be finalized in late 2012. So between now and that date, there's an opportunity for organizations to accelerate the capture and inventory of all of their leases. That is, again, the real estate and equipment leases. During the period from when the rules are finalized and actually come into effect, generally speaking, we're expecting those in either 2015 or perhaps as late as 2016. This represents the opportunity for organizations to rationalize that portfolio, to drive increased asset efficiency. And then after the rules come into effect, of course, we need compliance management. So what is it that IBM TRIRIGA delivers? Well, first and foremost, it delivers a set of capabilities to forecast that impact. Secondly, to simplify the financial assumptions management. And thirdly, to model those facility improvement scenarios. So as we look at those in a little bit more detail, forecasting the impact on the balance sheet. This is a set of processes to streamline the data capture. So lease abstraction, whether done internally or externally, can be streamlined for both real estate and asset leases. It captures all the relevant operational as well as accounting data required to deliver that assessment. Secondly, we provide pre-built data structures for the real estate leases and the equipment leases, both within the single system. And this again is really designed to capture the specific differences between a real estate lease and an equipment lease. One is tied to real estate assets, buildings, etc. The other one tied to IT assets, vehicles, and other types of equipment. Financial analysis and reports show the impact of the new rules on the balance sheet and also on the P&L statement. The new rules, as you can see in the middle of this chart, create some complexities. As are proposed today, there is a current model which shows a straight lining, and the new rules front load that. So there's an impact, as I said, on the balance sheet as well as P&L impact that organizations want to get a good handle on at both an individual lease level as well as across their entire leased asset portfolio. So moving beyond the initial assessment and analysis of the impact of these new rules, we're talking now about the ongoing compliance and really talking about the simplification of that. As I said earlier, the new rules create tremendous complexity for organizations in tracking this. So one of the key areas here is a requirement to do periodic reviews of both the operational parameters as well as the financial parameters associated with it. You know, some leases are tied to consumer price indexes or construction cost indices. So around the world, these, of course, change periodically and need to be updated in the system. So a set of bulk update capabilities that provide for the upload of that information into the different leases and to drive really the impact on the financial assumptions. So as these rates increase or decrease, how is it that the organization is going to respond? And then as those decisions are made, the system will track the before and the after, track who made the change, what their rationale for that change was, and deliver that in a set of automated logs and associated reports. So that auditors can come in and understand why the decisions were made and how that affects the organization. And then finally, let's talk about some of the benefits realized. So a number of IBM customers have certainly moved through their lease administration and really delivered a number of benefits. Nokia, one of them, saved €2 million per year based on a single alert that was generated by IBM TRIRIGA based on an automated lease renewal. If they took no action, they would have been on the hook for this additional €2 million. Because the system alerted them to this fact, they were able to vacate the property and terminate the lease. In General Electric's case, they really took on a portfolio consolidation and rationalization project. Over a course of, since 2003, over a course of about 4 years, they were able to generate more than $925 million in real cost savings associated with the rationalization of their facilities portfolio. To provide more information for you, I'd certainly encourage you to go out and visit ibm.com/Tivoli/beyond. Here you'll find the findings of the survey that I was talking about earlier. It analyzed the results of interviews and survey responses from 179 finance and real estate executives and really gets into what the strategic, operational, and technology impacts of these lease accounting changes are on billion-dollar-plus organizations. So if this represents your particular company, you want to understand the impact on your organization, please feel free to go out and view that report. Thank you.